In 1971, gold cost approximately $35 per ounce. In 2026, gold costs over $4,300 per ounce. That is a gain of approximately 12,186% in 55 years. In 1971, the S&P 500 stood at approximately 100 points. In 2026, the S&P 500 stands at approximately 5,500 points. That is a gain of approximately 5,400% over the same period. So at first glance, gold appears to be the clear winner, but here is the number that changes everything. When dividend reinvestment is included, the total return of the S&P 500 over the same 55-year period rises to approximately 7,000%. That is more than double the return of gold over the exact same period. But gold dramatically outperformed the stock market during specific periods. And those periods are exactly the ones that matter most to ordinary people. Today we are going to go through 50 years of real verified data. Compare gold and the stock market across every major economic period and give you the definitive mathematical answer to which one actually made ordinary people richer over the last 50 years. Let us start with the 1970s. The single best decade for gold in modern history, and the worst decade for stock market investors in the post-war era. In 1971, President Nixon ended the gold standard, severing the dollar's link to gold at $35 per ounce. Gold immediately began rising. By 1980, gold had reached approximately $850 per ounce, a gain of approximately 29% in just 9 years. During the exact same period, the S&P 500 returned approximately 77% in nominal terms. But after adjusting for the devastating inflation of the 1970s, which reached 14.8% annually by 1980, the real inflation-adjusted return of the S&P 500 was approximately negative 40%, meaning stock market investors actually lost approximately 40% of their real purchasing power during the 1970s, while gold investors gained approximately 29%. The primary driver of gold's extraordinary performance was stagflation, a devastating combination of high inflation, low economic growth, and rising unemployment. That is almost identical to the economic conditions the world is currently experiencing in 2026. During the 1970s oil crisis, gold was the single best performing asset class in the entire world. Any ordinary person who held gold during that decade preserved and dramatically grew their wealth, while anyone who held stocks or cash watched their real purchasing power collapse. After gold's extraordinary performance in the 1970s, the 1980s, and 1990s belonged entirely to the stock market. Gold peaked at approximately $850 per ounce in January 1980 and then fell consistently for the next 20 years. By 2000, gold had fallen to approximately $272 per ounce, a decline of approximately 68% from its 1980 peak. Over the same 20-year period, the S&P 500 delivered one of the greatest bull markets in financial history. From approximately 107 points in 1980 to approximately 1527 points by 2000, a gain of approximately 1327% over 20 years. With dividends reinvested, the total return was approximately 2200%. The primary drivers were falling inflation, falling interest rates, technological innovation, and the explosive rise of the personal computer and internet economy. Any ordinary person who invested consistently in the S&P 500 during the 1980s and 1990s built extraordinary wealth, while anyone who held gold watched their investment lose approximately 2/3 of its value over 2 decades. The dot-com crash of 2000 marked the beginning of gold's second great era of outperformance. The S&P 500 fell by approximately 49% between March 2000 and October 2002. And did not recover to its 2000 peak until approximately 2007, only to then collapse again during the 2008 financial crisis, falling by approximately 57% between October 2007 and March 2009. By the time the S&P 500 finally recovered its 2000 peak level in approximately 2013, ordinary stock investors had experienced 13 years of zero net returns. Meanwhile, gold rose from approximately $272 per ounce in 2000 to approximately $1,900 per ounce by 2011, a gain of approximately 599% over 11 years, during the same period that the stock market delivered zero net returns to ordinary investors. Gold recovered far faster than the stock market from the 2008 crisis and went on to reach new all-time highs by 2009, while the stock market took until 2013 to recover its pre-crisis levels. The 2010s were another extraordinary decade for stock market investors and another disappointing decade for gold. The S&P 500 rose from approximately 666 points at its March 2009 low to approximately 3230 points by the end of 2019, a gain of approximately 385% over 10 years. With dividends reinvested, the total return was approximately 500%. Meanwhile, gold fell from its 2011 peak of approximately $1,900 per ounce to approximately $1,520 per ounce by the end of 2019, a decline of approximately 20% over the same period. According to Federal Reserve data, the number of American millionaire households grew from approximately 7.8 million in 2010 to approximately 13.6 million by 2019, an increase of approximately 74% in just 10 years, almost entirely driven by stock market returns during the decade. The period from 2020 to 2026 has been the most fascinating period in the entire comparison. The S&P 500 crashed by approximately 34% in March 2020 during COVID, but recovered its entire loss within just 6 months and went on to reach all-time highs by the end of 2020. From the March 2020 low to the end of 2021, the S&P 500 gained approximately 100%. Gold simultaneously rose from approximately $1,470 per ounce in March 2020 to approximately $2,070 per ounce by August 2020, a gain of approximately 41% in just 5 months. Between 2022 and 2026, the Iran war, elevated inflation, and global economic uncertainty created perfect conditions for gold. Gold rose from approximately $1,800 per ounce in early 2022 to over $4,300 per ounce in 2026, a gain of approximately 139% in just 4 years. The current 2026 environment of elevated inflation, geopolitical conflict, and the $111 trillion global debt crisis is creating conditions that historically favor gold, while the long-term structural advantages of stock market investing continue to make it the single most powerful wealth building tool for ordinary investors over decades. Now here is the complete definitive mathematical comparison across the entire 50-year period. $1,000 invested in gold in 1971 at $35 per ounce would be worth approximately $1,228.57 in 2026, a gain of approximately 1,186%. $1,000 invested in the S&P 500 in 1971 with all dividends reinvested would be worth approximately $271,000 in 2026, a gain of approximately 27,000%. The stock market with dividend reinvestment outperformed gold by approximately 2.2 times over 50 years, but gold dramatically outperformed the stock market during the 3 most economically devastating periods of the last 50 years: the 1970s stagflation crisis, the 2000 to 2011 lost decade for stocks, and the current 2022 to 2026 inflation and geopolitical crisis, meaning gold is not a wealth-building asset, it is a wealth preservation asset. It protects ordinary people's purchasing power during the exact periods when the stock market is most dangerous, and the stock market is a wealth-building asset. It creates extraordinary returns over long periods of economic stability and growth. The data across 50 years does not say choose gold or choose stocks. It says own both, and understand exactly when each one performs best. Right now in 2026, the economic conditions are more similar to the 1970s than to any other period in modern financial history. Inflation is elevated and persistent. Geopolitical conflict is driving oil prices past $100 a barrel. Global debt has reached an unprecedented $111 trillion. During the 1970s, which featured almost identical conditions, gold gained approximately 23-29%, while stocks lost approximately 40% in real terms. Gold has already risen from approximately $300 per ounce in 2002 to over $4,300 per ounce in 2026, a gain of over 1,300% in just 24 years. Silver has hit almost $70 per ounce. The IMF projects global inflation remaining elevated between 3 and 5% annually through 2028. Goldman Sachs has raised its gold price forecast to $4,500 per ounce by the end of 2026. The current data strongly suggests that the conditions favoring gold over stocks in the short to medium term are more powerful right now than at any point since the 1970s. So what should any ordinary person do right now? Do not choose between gold and the stock market. The 50-year data is absolutely clear that the most financially successful ordinary investors owned both. Allocate approximately 60 to 70% of your investment portfolio to broad market index funds tracking the S&P 500. Allocate approximately 5 to 15% to gold and precious metals. During periods of high inflation and geopolitical uncertainty, like right now in 2026, increase your gold allocation toward the higher end of that range. During periods of economic stability and low inflation, increase your stock market allocation toward the higher end of that range. Always invest through dollar cost averaging every single month, regardless of which asset is currently performing better. Never try to time the market by switching entirely between gold and stocks based on short-term performance. The 50-year data shows that investors who consistently owned both assets through every economic cycle built significantly more wealth than those who tried to pick the right time to switch between the two. Here's the definitive answer to the question this video started with. Which one actually made ordinary people richer over the last 50 years? The stock market with dividend reinvestment turned $1,000 into approximately $271,000. Gold turned $1,000 into approximately $122,857. The stock market won over 50 years, but gold won during every single period of crisis, inflation, and geopolitical turmoil, including right now in 2026. The data does not say choose one. It says understand both, own both, and let each one do what it was designed to do. The stock market builds your wealth during times of stability and growth. Gold protects your wealth during times of crisis and inflation. And right now in 2026, you need both more than at any point in the last 50 years.